Let's dive deeper into the action with our markets reporters. Abigail, what are you watching?
You know, Joe, I'm thinking about a stealth sell-off that's happened on this week, and that is the dollar index. If we take a look at a 4-day chart of the Bloomberg dollar index, we're going to see a 1% decline. This is the worst stretch for the dollar since late June, having everything to do, of course, with the strength in the British pound, the Turkish lira, and, of course, some other emerging market currencies. It's done technical damage in an otherwise bullish chart. This is a one-year chart of the dollar index, the DXY. We see an uptrend, the buyers, the bulls, the dollar bulls in charge above the 200-day moving average for the most part. But on this week's weakness, we're really coming back into the range. Today, we slice back below that 200-day moving average. This suggests we're likely to see the Dixie, the DXY, go down to about 96.50. If below those levels, Sarah, it could get pretty interesting, considering that would be a true breaking of support. But right now, it looks like there's probably a little more consolidation, at least, ahead for the dollar, Sarah.
Abigail, well, if you look at the broader market, there certainly is a lot of indecision. If you look at relative asset classes, or if you look within the equity market. I'll start with asset classes. According to Ned Davis research, if you look at the relationship between stocks and bonds, it has not been so indecisive. The two both up to such extremes since all the way back in the early 1990s. And if you take a look at the equity market, we are seeing something similar. It's this push and pull between those who think that growth is going to return, albeit a little slowly, versus those who think we could go into recession. If you take a look at this chart, what you're looking at is the spread in weekly performance between an MSCI index that follows defensive stocks versus an MSCI index that looks at more cyclical stocks. And we have seen outperformance really alternating over the past 5 weeks. That is something that we have not seen since all the way back in December. I spoke with one investor over at RW Baird, and he said that this really is max frustration for investors since there really is no trend. Vernita.
Thanks, Sarah. I'm taking a look at a base metal that we don't hear a lot about, but is definitely in the industrial space. Nickel, it's having its worst week since 2017, and this is all on slowing growth in China, weighing on the demand for the metal. The Chinese economy grew at its weakest pace since early 1990s in the third quarter of this year. This provided little upside for the global economy, flirting with its first recession since 2009. A nickel slump came after a warning that plunging inventories on the London Metal Exchange are contending with loose underlying supply conditions. Cash contracts have also traded at a smaller premium to futures in the past week. This suggests that the squeeze faced by buyers on the London Metal Exchange is actually easing. Traders are moving nickel stockpiles from China to other Asian warehouses to capture more profits by delivering it to the London Metal Exchange. And analysts, by the way, they say that declining industrial activity and heightened concerns of slowing global economic growth leave little hope for the materials and base metals industries.